Good afternoon, everyone, and welcome to the 2021 Professional Advisory Kickoff event. I'm Kay England, President and CEO of the Community Foundation of Northeast Iowa, and it's really our honor and privilege to be able to host this professional advisory event again today. We want to begin by really just expressing our gratitude and thanks for your continued support, referrals to our efforts, and just in particular, just your professional leadership and guidance as you work with charitable clients. We greatly appreciate it. Other organizations, of course, greatly appreciate it. And it really is our joy to assist in generous community members connecting with charitable causes that they support now and into the future. Special thanks to our investment committee members. I see many of you on here already today. Shout out to Pat Monett, who is our current board chair, and also on the investment committee, Scott Cernett, our investment committee chair and past board chair, Stacy Brass, Nick Blasberg, Todd Henningsen, Mike Holme, Jessica Jenkins, Mark Miller, Matt Monahan, Aaron Sonis, and Gary Winterhoff. Those are our committee reps that are on with us or are representing the organization in that way. Our committee does meet quarterly. Dave Smith is part of those quarterly meetings, and basically what we're looking at is ways that we can continue to provide oversight for our portfolio and to ensure the management of our assets in partnership with Marquette Associates is in a good place. One of those major responsibilities of the board of directors and this committee, as I mentioned, is really to provide that oversight of our assets and to ensure the fiduciary responsibilities of our organization are being carried out as we manage nearly $120 million in assets currently. We have several staff with us today that I want to give a quick shout out to. Liz Kurt, who was our Vice President of Finance and Administration. She is running the behind the scenes there and works very closely with our board and our investment committee. Terry Gomer, our Development Director, and Lori Everhart, Development Director, are both with us today. So we are here to assist you in your in carrying out your charitable goals now and into the future. And I invite Lori to share some updates with our group.
Hey, thank you, Kay. Today is the first in our series of professional advisor events that we will host throughout the year. We want these sessions to be tailored towards your interests and your needs. So you will actually, in the next week or so, receive a short survey asking for your feedback on your work with your clients in the areas of philanthropy, as well as the topics that you would like to explore in the upcoming sessions. So I just ask that you please take a few minutes to give us your thoughts when it lands in your email. Now, today's session will have continuing education credits available. Our plan is we will send out the CLE number with our follow-up email to attendees. And if you need CFP credits, you can please, best way to do it, I think, would be to send me a message through the Zoom chat with your CFP number so we can turn that information in. If you don't have that number available, still send me a message so I know that we need to make contact by phone later or however to get that information. So at this time, I would like to introduce Dave Smith with Marquette Associates, whose organization provides the oversight for our investments. Dave is a managing partner for Marquette Associates, and owner of the firm. Dave has been with the company since 2009, and he serves as the lead investment consultant on several of the firm's relationships and serves as the vice chair of the Traditional Investment Manager Search Committee and the Defined Contribution Services Committee. And Dave holds his undergraduate degree in finance from the University of Richmond, as well as an MBA in finance from the University of Chicago's Booth School of Business. And he is a CFA charter holder and a board member of the CFA Society of Chicago. So thank you, Dave. We'll turn it over to you.
Thank you, Lori, and good afternoon, everybody. This is now the third time that I've been invited to participate in this event. It's certainly an honor and a privilege. And the themes that we'll talk about here today are consistent with the themes that my colleagues and I think about when we're overseeing a wide variety of different client portfolios. And these are the themes that we review and address with this investment committee. I understand that the folks on this call and on this phone are responsible for or interact in markets and are responsible for client portfolios of their own. So hopefully this is a chance for us to come together again and reflect on what's happened in 2020 and think about how these themes will impact client portfolios, our own portfolios, in over the next 12 months. Please feel free to interrupt with questions. I'll do my best to answer, or we can save those to the end. But in thinking back over the last now three instances, or this is the third instance, 2018 or year ending 2018, 2019, and 2020, we've been confronted with very distinct themes that have impacted capital markets. In 2018, we experienced four interest rate hikes, and that was really the fourth in a final series of 9 that started in 2015. We saw interest rates go from basically 0 to almost as high as 2.5% as we emerged from the global financial crisis. And the outlook, at least at the end of 2018, was that we would see more interest rate increases into 2019. We saw a sharp deterioration in equity prices. We saw a negative calendar year return, I think maybe the 6th in the last 30 years, when we saw a market that produced basically flat bond prices. So it was a very sort of dire outlook as we were getting together and reviewing this material in 2018. In 2019, it was a complete opposite story. The Federal Reserve quickly reversed course in January of 2019, and we saw 3 interest rate reductions, the first reductions really since before the global financial crisis. Lower interest rates lead to more attractive equity market valuations, and equities rallied significantly. And of course, here we are today, and we have a number of different themes that have dramatically impacted markets in 2020, most of which we certainly didn't expect when we gathered here a year ago. We saw, and we probably expected, a contested presidential election, which we certainly experienced. But we certainly didn't anticipate a global pandemic and the massive amount of stimulus that's followed worldwide, and especially in the US. So those are some of the primary themes that we will think about. In what way has this stimulus impacted capital markets? And in what way will the implications or that level of stimulus impact stocks, fixed income, and asset classes that are available to institutional investors like the Community Foundation across real estate, real assets, and private equity? So again, if there is anything that's on your mind, please interrupt and we can talk through these issues. But we'll start really with an overview of some economic activity, and then we'll think about the asset classes that are really most important to us. And of course, that's fixed income, core and core plus fixed income, equities, non-US equities, real estate, private equity. And to start with, and I know that everyone is probably well aware of the implications of the COVID crisis, and just a reminder that this has impacted almost 100 million people across the globe. We have, across the number of active cases, deaths, and recoveries, close to 90 million, if not more, and this was as of 12/31. What is also staggering is the number of recoveries, and obviously that's very positive to see that we are able to move beyond this. But in the United States, of course, we've lost far too many people, and that's had obviously an implication or impact on sort of our behaviors, and then of course the stimulus primarily from the federal government. And just to sort of summarize all of the stimulus, and there have been a number of different iterations that have been introduced much more quickly than we saw following the global financial crisis, but probably the all-in number, the number that maybe is the biggest headline, is the number at the very top. The total amount of fiscal stimulus that's been introduced into the United States economy is roughly almost 3.5 trillion, or 16% of GDP, across a number of different iterations. The federal government moved quickly. It moved in massive scale in introducing this stimulus, which is different than what we saw from the global financial crisis. Generally speaking, I think stimulus from the financial crisis was somewhere in the neighborhood of 800 million, or 3 to 4% of GDP, which at the time was one of the largest introductions of stimulus ever. And we'll talk about the implications or the lack of implications around potential inflation following the global financial crisis. But what is very important here is that this stimulus was injected directly into American households through paycheck protection, into state and local governments, really designed to support households and families that were struggling, especially those in sectors that have been far more impacted: travel, leisure, hospitality, where we've seen high levels of unemployment. If we contrast this level of stimulus versus the stimulus following the global financial crisis, most of that stimulus went into the banking system, into excess reserves, and only a modest amount was then part of the overall lending program. We never really saw implications around inflation following the global financial crisis because we never saw spending increase. We never really saw wages increase. We also saw a demographic shift away from the workforce as the labor participation rate started to decline as baby boomers forever exited the workforce. And we continue to see a change in demographics, a change in the overall labor force participation. But I think a key takeaway here is, or the key takeaways, the magnitude of the stimulus, the speed with which it was introduced, and how it was actually introduced directly to households and families. We've certainly seen through quantitative easing uplifting equity markets, and we would expect that we will see that within overall consumer pricing, recognizing that we never really saw inflation during the last episode. So these are just themes for all of us to keep in mind. So in terms of overall debt, the amount of debt issued, we are reaching debt levels not seen since World War II. Obviously, that debt was used to finance military movement on a global scale. And the projection is that debt will approach 100% of GDP. GDP is now approximately, call it 21 trillion. That is a tremendous amount of debt that obviously will have repercussions as the government continues to introduce more and more bonds to the global economy. And generally speaking, investors have an appetite for U.S. government fixed income because we'll see in just a minute, the yields on U.S. debt is more attractive than the yields that we see from other developed markets.
Dave?
Yes.
Sorry to interrupt. On your screen share, we're still on slide 1. Can you advance?
Oh, really? Okay. Sorry. Thanks. Let's see. That's not advancing. Is that right?
Right.
Oh. Uh-oh. What can you see now?
There you go. Now it's moving.
Okay. All I did was move it from one screen to another. That's the extent of my technical capabilities. But that didn't work. I was going to unplug the system and start over. So we really only missed 2 slides, but just the illustration on page 5 just shows the increase in the magnitude of debt as a percentage of overall GDP, levels not seen since World War II. The stimulus, however, does seem to be working, as evidenced by metrics around auto loan delinquencies, credit card mortgages, home equity lines of credit, and student loan. The CARES Act has probably had the biggest implication in allowing graduates to pay and service their college loan. That probably represents the most significant decline in overall delinquencies, and that's college loans. And that's probably one of the biggest sources of concern and sources of restraint for millennials as they have exited the workforce, is this ballooning amount of college debt. So stimulus has been helpful in that front. However, we have started to see a very modest upswing in auto loans and credit card delinquencies, which is probably not surprising given the fact that we have seen record levels of unemployment. By contrast, however, most households seem to be up to speed with their mortgages or any sort of home equity line of credit. This is a reassuring sign that despite maybe the high levels of unemployment, that American households, while some are struggling, are overall in not that dire, not that delinquent in some of the most impactful sources of debt in their household. Now, when we think about what the Federal Reserve will do or may do over time in terms of rising interest rates and thinking about the overall monetary supply, Monetary supply is probably one of the biggest sources of inflation. If we think about maybe one of the more basic concepts in economics, the quantity theory suggests that the supply and demand of money are one of the biggest sources of overall inflation. We've seen monetary supply, or M2, basic measure of monetary supply, increase by about 24% from March to November. Increased monetary supply could lead to higher levels of inflation. However, at least evidenced by this chart here, we still see market implied inflation and realized core inflation, or CPI, still below 2%. The Federal Reserve has been very clear that they try to, or they will not raise rates even if inflation exceeds 2%. So at least based on this metric, the likelihood of higher rates, which can impact bonds and equities, are probably not that likely, at least over the course of the next year or so. And again, the Federal Reserve earlier in maybe the second or third quarter has suggested that they will probably not raise rates until 2023. And then output gap. This is a measure of how much slack we actually have in our economic system. And as evidenced by the lines on the far right, we still have a significant amount of gap. Real GDP is less than potential GDP, so implying that we can continue to hire more people, we can continue to increase wages, we can continue to be more productive without having a meaningful implication or impact on overall inflation. Output gap is still low. There's still slack in the system. That could change, especially as if vaccinations take hold, more and more people get them. The Biden administration is able to make good on the promise to roll out 100 million vaccinations, and we could return to a normal working environment very, very quickly. That could certainly introduce inflationary pressures. And as we think through recessions that are a result of structural change, the global financial crisis, perhaps what was brought on by a dislocated equity market in the dot-com era, versus natural disasters or pandemics, there tends to be much faster recovery. And that could certainly be the case if this vaccination is successful, if we are able to reopen in the US and markets beyond. We could very quickly see an acceleration or a closing in that output gap. So with that as a primer, we'll use this to sort of set the stage for how we think about, again, key asset classes, core and core plus fixed income, equities, real estate, private equity, and across the board, publicly traded capital markets have had an outstanding year, which is phenomenal considering at one point back in March, I think we were all panicked. We were all glued to Bloomberg or CNBC, and equity markets had dropped by as much as 35%. That was the fastest and largest drop that I think we've ever experienced in US stock market history. And then if we had just closed our eyes in January from this last meeting and until this meeting, we would have seen very attractive results. Interest rates quickly decreasing from almost 2.5% 2 years ago down to zero had a dramatic impact on overall fixed income, whether it's core fixed income at the very top. Think of this as investment grade corporate credit. U.S. Treasuries returned over the last year 7.5%. For most pension plans, that is exactly the actuarial goal rate of return that they are trying to achieve. And that's very close to the goal rate that we're trying to achieve here at the Community Foundation. If we think about long-term government debt, which tends to have a higher duration or more interest rate sensitivity, it's hard to believe that long-term government bonds are probably one of the best performing asset classes, up a staggering 17.6%. Returning double digits for doing nothing more than holding or lending the government long-term capital is a great way to invest money. Unfortunately, that probably won't be the case going forward as interest rates have come down significantly. And then finally, corporate credit, long credit, high yield, senior secured loans. As investors have renewed their risk or their risk appetite and interest in equities, we've seen high yield perform as well. Just an important reminder of why we should think about having core fixed income as a portfolio ballast, supported by core plus sectors, whether it's emerging market debt, high yield bonds, or senior secured notes that offer bonds that offer variable rates, offer protection during periods of rising rates. So just to illustrate two points on this next slide. One, the steepness or flatness of the yield curve, and then the amount by which short-term and the 10-year Treasury decreased over a very short period of time. If we look down the 12/31/2018 column, we see very little difference between the yield on the 3-month and the yield on the 10-year. The difference is 20 or so basis points, a very flat yield curve. When we were looking at this information about a year and a half ago, I think it was the summer of 2019, we had a flat or even inverted yield curve. Historically, an inverted yield curve is a telltale sign that we are about to be confronted by recession. Now, we did encounter a recession, but it was not for reasons that were implied by an inverted yield curve. But the message here is that we went from a flat yield curve to an upward sloping yield curve, suggesting that there is signs that interest rates will increase. The other key theme is that from the year end 2018 through the year end 2020, we saw interest rates decrease by about 2.5%. That decline in interest rates is almost entirely responsible for increased bond prices. Bond prices move inversely to interest rates, and as interest rates come down, we see higher prices. Unfortunately, going forward, this also suggests that bonds being issued in this environment will have a very low yield. Something to think about if investors have goal rates that are somewhere in the neighborhood of 6, 7, even 8%, and there's some allocation to core fixed income. Very difficult to maintain overall portfolio returns of 7.5 or higher with high allocations to at least core plus fixed income. So in what way did the Federal Reserve in part lower interest rates? And they did that by buying a tremendous amount of debt. The federal balance sheet is now, call it 35% of GDP. I think that number is somewhere around 7 to 8 trillion. $7 to $8 trillion sit on the Fed's balance sheet as they have purchased bonds following the global financial crisis. We can see that start to deteriorate or start to wind down as those bonds matured following 2015, which is partially responsible for a rise in interest rates. But we never really saw this bond buying program, which is commonly referred to as quantitative easing, until the global financial crisis. Historically, the Federal Reserve debt was equal to 5% of GDP. Dating back 30 years to 1990, that was under $500 billion, and that is now ballooned to almost 8 trillion. Eventually, that debt will mature. The bonds, where the Fed will stop buying bonds, but that will generally lead to higher interest rates. How quickly and how fast, that's difficult to determine, but this is certainly a stark contrast to what we normally see. And thinking through the implications for bond holders for interest rates as this Fed balance sheet starts to unwind is what we need to be thinking about in terms of how to allocate capital. How was this crisis like 2008? This is on the left-hand side, we see below investment grade fixed income, double B, single B, triple C, from the COVID crisis compared to below investment grade fixed income from the global financial crisis. And in both instances, we saw a significant deterioration in fundamentals from credit, just like we saw with equity markets, followed by a rebound. The key difference from the chart on the left, COVID versus the chart on the right, is that recovery was much, much quicker. The Federal Reserve and central banks worldwide intervened very, very quickly with massive amounts of stimulus, and that helped expedite a recovery that really occurred over a period of months versus the global financial crisis, where we felt that pain for the better part of 12 to 24 months. Much, much quicker recovery in credit and equity markets. So across the globe, we think about central bank intervention. Lowering interest rates means lower yields, nominal and real yields across developed markets, making global fixed income perhaps an unattractive asset class. So we want to think about that, whether it's the foundation's portfolio or allocations to global fixed income. There are negative yields that are not very attractive. However, typically we allocate this decision making to active bond managers who invest across a wide opportunity set, and they probably forego holding bonds with negative yields in favor of bonds with higher yields, emerging market debt, high yield, senior secured loans, an asset class that still offers compelling yields. And it also offers a much broader opportunity set. The global fixed income universe is massive. The number of bonds that are available to institutional global bond holders is very large. So we need to be mindful of negative rates. We also need to be mindful of the opportunity that exists across the global landscape of fixed income. So where should we be allocating capital if we need to maintain some allocation to fixed income? Fixed income continues to be the ballast in a portfolio. That is the asset class that offers protection when equity markets sell off, when credit markets deteriorate. Investment grade fixed income, and most importantly, US Treasuries were really the only asset class or sub-asset class that offered any level of protection. Unfortunately, as evidenced by that the core label on the yield section, core fixed income, again, investment grade fixed income, US Treasury, has a yield somewhere in the neighborhood of 1%, very low yields. By contrast, investors can allocate or increase the risk profile with bank loans, senior secured loans, high yield bonds. And even though those yields are at the very low end of historical ranges, still much more attractive than what we're seeing or what we can potentially earn from core fixed income. Somewhere in the neighborhood of 4 or 5%. Slightly more risk. Obviously, the likelihood of default is a little bit higher than what we would see from investment grade corporate credit, but still there's a higher yield component, and fixed income senior secured loans is higher in the capital structure, offers more protection than equities. A meaningful part of a portfolio should be allocated to opportunistic credit. High yield is a way to increase return while not moving too far away from a fixed income allocation. So US equities. US equities, I think, as we all know, have experienced a significant roller coaster. It's probably not, we probably don't need to go through this in too much detail, but what is worth pointing out is the significant gap between value equity, whether it's large cap value, mid cap value, small cap value, and its growth counterpart. And I've highlighted in the large cap space the difference between large cap growth. Think about tech companies versus large cap value cyclicals. These are namely financials, manufacturing sectors, industrials that have really been hit hard as we experienced recessionary trends in 2020. The difference is almost 36%, probably one of the largest gaps between value and growth. And that theme really has persisted over the better part of the last decade for a number of different reasons. We did see a modest reversal. Hopefully that continues to take shape in the rest or in the fourth quarter of 2020 and into 2021. But the disparity between growth and value has been significant, especially for those investors who tend to have favored value. That's been a painful way to grow assets. As we think about volatility, and I think this is at slide 18 is a very useful slide in terms of perhaps easing the minds of individual investors or boards and committees. Stock market volatility is part of equity market investing. Every other year, as evidenced by that green diamond, we experience a correction. A correction is a sell-off of 10% or more. Every decade or so, we experience a bear market, which is a sell-off of 20% or more. That creates opportunities to buy at a discount. That creates opportunities to expand value, but unfortunately, it creates anxiety among boards, anxiety among members, and certainly creates anxiety among investment consultants, but it's a normal part of equity market investing. Last year's drawdown was close to 34%, which still doesn't come close to what we experienced in 2008. But the point here is that we see a significant amount of volatility. Drawdowns are normal, but only in 6 instances in the last 30 years have we experienced a negative calendar year return. Very large one in 2008, 3 in a row, which is also unusual following the dot-com bust. And then in 2018, as we saw interest rates increase significantly in that year. But however, despite a sort of a large sell-off, we experienced a very positive year with equity markets. Just to set the stage around volatility or some sort of comparison, we saw 109 days of plus or minus 100 basis points or 1% within the S&P 500. We haven't seen that level of volatility since the global financial crisis, where we saw that really kind of 2 or 3 years in a row. So that level of volatility is unnerving, but again, it's part of overall equity market investing. Earnings collapse primarily in cyclicals. We think about the types of sectors, the types of companies that are most impacted by economic downturn: manufacturing, industrial, airline, travel, leisure, lodging, and energy in particular. However, the expectations for these sectors in 2021, as we're starting to see signs of recovery, are a little bit more positive. This outlook for positive earnings across these sectors have really been responsible for driving maybe some mean reversion within the value sector and improved performance among cyclicals in the fourth quarter. Now, just a moment or two on concentration. This slide here, 21, illustrates the performance of the 5 largest companies in the S&P 500. And these are companies like Facebook, Apple, Google, Alphabet, the large tech companies. Those stocks, or those 5 names, returned in 2020 53 or 55%. By contrast, the rest of the S&P 500 represented only 10.6% return. So we saw a very concentrated return from the S&P 500 that certainly gave us comfort, but we need to recognize that it's dominated by just a handful of names. And here we illustrate across whether it's the S&P 500 core large cap equity, the Russell 1000 growth, or by contrast, the Russell 1000, the impact of those 5 names. These 5 names, Alphabet, Amazon, Apple, Facebook, Microsoft, represent 36% of the Russell 1000 growth, a tech-heavy benchmark, roughly 20% of the S&P 500. If we start to see a deterioration or increased regulation in the tech space, which probably would have been likely under any sort of administration, we may see a pullback in technology. Another just interesting observation is we think about valuation metrics, price to earnings, as a way to value or express concern that stocks are overvalued. The percentage of intangible assets as a percentage of the capitalization of the S&P 500 has changed dramatically over the years. Intangible assets are things like intellectual property, software, versus brick and mortar enterprises, factories, equipment. That percentage has decreased or increased from around 20% in the 1970s to 90% in the year 2020. 90% of the market capitalization of the S&P 500 is in intangible assets, meaning that the valuation metrics that we have historically used to evaluate assets may no longer work as well. So it's something to consider when we evaluate companies like this and the implications that large tech has in the S&P 500, or as we'll see in just a minute, emerging market indices that are even more concentrated in the S&P 500. 23 illustrates just the prolonged disparity between value and growth over a rolling 10-year period. When the blue line is above that x-axis, we have seen growth outperform. When it's below, value is outperformed. Value was obviously the place to invest as the world emerged, or as the U.S. emerged from the dot-com crisis. However, that has certainly not been the place to invest following the global financial crisis. Growth has performed or outperformed value on a significant basis, and now represents a significant standard deviation event from what we would expect to see from value. We hope to see mean reversion. We allocate across value and growth, our core strategies, but this growth run has certainly been very long and unprecedented. Further exacerbating that challenge, the most expensive stocks have been the best performing stocks. As a value investor, the idea is to invest a stock that's cheap and hope that grows in value, or hope that there is some level of dislocation that will restore that value. More or less expensive stocks lead to more opportunity. Unfortunately, the most expensive stocks, as we separate those by quintile, have been the best performers. Expensive stocks have led to long-term results, which is a stark contrast to most value investing philosophies. And the same is true, or that same anomaly is true when it comes to profitability. The black bars, or the darker charcoal bars, suggest that more profitable companies within the S&P 500 have produced better returns. That's very intuitive. That's why we're investing in companies, because they are profitable. Unfortunately, that was not the case with small cap companies measured by the Russell 2000. The least profitable companies drove the most significant returns. The more indebted companies drove more significant returns, which makes it incredibly challenging for those investors who rely on active managers to pick stocks based on profitability when that profitability is not there, or companies with negative or low profitability haven't produced returns. It becomes very difficult to maintain allocations to small cap. Now, what happens when we have changes in administration under a unified government, split Congress, or unified Congress with the president and a different party? And obviously, we're now in an environment where we have unified government, and there doesn't seem to be much difference between these three relationships, at least dating back to 1933. Unified Congress with a president and the other party produces the most underwhelming results, at least historically. Under a unified Congress, which of course is what we have now, has produced very attractive results. Equity markets have returned 10%. Now, this is based on historical observation. Very difficult to glean what can potentially happen, especially if the Biden administration introduces more taxation, more government spending, but at least based on historical evidence, a unified government has led to attractive large cap US equity returns. And then in an inflationary environment, which of course could be the case given the dramatic increase in monetary supply, very low interest rates, generally speaking, at least across these inflationary periods, equity markets, whether it's a large cap, the S&P 500, the Russell mid cap, or small cap stocks have performed well, which we would expect, right? In an inflationary period, we see periods of growth, we see periods of expansion, and equities tend to do well. What this may not necessarily capture is rising interest rates that typically accompany inflationary periods. Once inflation becomes an issue, once inflation exceeds 2 or 3%, the Federal Reserve intervenes and starts to increase interest rates. We saw in 2018, higher interest rates depressed equity market prices, and it certainly has an impact on overall bonds. Higher interest rates basically increases the cost of capital, increases the discount rate, and leads to lower valuations from equity markets. So based on these metrics during periods of inflation, equities have done well. What we need to consider is the impact of rising interest rates during periods of or following periods of inflation and that impact on overall equity markets. Moving on to non-US equity. Non-US equity continues to be a very important part of a broad opportunity set when we think about overall market capitalization and public equities that are available to investors. Roughly, call it 55% is traded in the United States. Roughly 45% of all stocks are traded overseas. The opportunity set is expansive and having an allocation that's roughly 60 to 70% US, 30 to 40% non-US tends to lead to very attractive results. Emerging markets, as investors have risked on, have offered access or path to technology to China in particular, which has really supported overall equity market growth. And then non-US small cap tends to be one of the more inefficient asset classes, tends to offer the most room for active managers to add value, and is also an asset class or sub-asset class that investors are attracted to when they re-risk. And we've seen that as investors have re-entered non-US equity markets. Emerging market equities, non-US small cap performed incredibly well. And we also need to consider the implications of overall currencies. And I'll draw your attention to the difference between MSCI EAFE developed markets and MSCI EAFE in local currency. The EAFE takes into consideration dollar-denominated US-based investors. And we can glean from that difference of almost 700 basis points that US-based investors who are investing in developed markets with US dollars has seen a basket of currencies increase. Currencies have across developed markets have improved returns. However, for that same investor to only hold local market equity, the return was basically flat. That difference in currency really impacted overall developed market equity experiences for equity investors. Uh-oh. Can you still see?
Yes, we're good.
Okay.
Actually, a little better view here.
Oh, that's good. Okay. As we think about emerging markets and perhaps one of the best returning sectors, at least within the non-US equity space, it's interesting to call attention to just how concentrated emerging market equity is. We spoke earlier about the concentration risk that exists within the S&P 500, the Russell 1000 growth across kind of 5 key technology names. That concentration is even higher in emerging markets. Names like Alibaba, Tencent, Samsung, Taiwan Semiconductor represent 23% of the MSCI Emerging Market Index and introduces more concentration risk than the S&P 5, Japanese equity, or European developed market equity. So just being aware of allocations to emerging market equity while that represents a very broad region, is more concentrated than equities that we have access to in the U.S. What's also interesting around emerging markets is the disparity that exists across region. The gray bar or that brown bar represents the allocation to cyclicals. These are sectors like financials, industrials, materials versus technology in the blue bar. Not surprisingly, the S&P 500 has the largest concentration of technology across any of these indices profiled below. Followed by emerging market Asia. Emerging market Asia is very driven by the technology sector, having exposure to China, having exposure to Southeast Asia, to India, it increases the allocation to technology. By contrast, and equally important within the emerging markets landscape, Latin America and emerging market Europe, very low allocations to cyclicals. These are regions that are still very reliant on brick and mortar companies, on cyclical sectors, and those cyclical sectors have really disappointed, at least over the course of the last few years. We have seen a resurgence as of late, but just having an exposure to emerging markets introduces disparities across sectors that we should be aware of as fiduciaries and stewards of capital across client portfolios. PMI, which is a measure of, or the Producers Manufacturing Index, which is a measure of overall economic output. Any reading above 50 represents economic expansion. Any reading below 50 represents economic contraction. Not surprisingly, across these markets, China, US, Eurozone, UK, Japan, we saw a sharp deterioration in PMI, economic contraction following COVID. China was the first country to really at least be able to restrain growth of COVID, bring COVID under control. So we saw a sharp increase in PMI and very healthy recovery that really exceeds where China was prior to the COVID crisis. And in basically every instance, we've seen healthy recovery and economic expansion across all of these markets, which we would continue to experience, especially as vaccines are introduced and as the world reemerges. And in fact, this could dramatically accelerate due to the high concentration of monetary supply and the amount of capital that's available to households and investors. And just a reminder, why do we have equity or non-US equity in portfolios? Non-US equity has trailed US equity by a significant amount. By capitalization, non-US equity represents just under half of overall global market capitalization. But these trends tend to be mean reverting, just like what we discussed or reviewed with value versus growth. Non-US equity outperforms US equity for periods of time based on rolling 5-year performance. The Russell 3000, which is a broad market index, underperformed non-US equity for the better part of the 2000s as the US emerged from the dot-com crisis. So having allocations to US and non-US equity and maybe representative weights that are representative of global market capitalization can be helpful. It's difficult to say if we're starting to see a trend or a deterioration in US equity market fundamentals relative to non-US equity, but obviously these trends and this element of mean reversion has been something that's part of equity market investing for the better part of the last 20 years. Real assets, and more specifically real estate. Real estate's an asset class, or private real estate's an asset class that's available to institutional investors. Retail investors can access retail or real estate through REITs. We've seen more institutional investors like the Community Foundation shift away from fixed income into core private real estate as a way to source diversification and, more importantly, source income from an asset class, fixed income, that was very low yielding. I'll draw your attention to the second row from the top, income in the NPI. Over the last 5 years, the income generated from core properties, which are office space, industrial, retail, and apartments, has been around 5% higher than what investors were able to source from core fixed income. That compounded with overall appreciation in property prices as the world emerged from the global financial crisis led to a total return for real estate that almost approximated 9.5%, much more attractive than what we saw or what we could have earned from core fixed income. Not surprisingly, as we look at these sectors that are highlighted in blue, the hotel sector, which has been impacted by travel and leisure or lack of travel and leisure, has declined significantly. The overall valuation of hotels has contracted. This represents a very small portion of core open-end real estate, but nonetheless, this is emblematic of how quickly investor and household and business traveler appetite for hotel stays can change, especially given the backdrop of the pandemic. Industrial, on the other hand, has been the top performing sector as households have reapproached the way that they shop, the way that they consume. That trend was in place already as a result of the Amazon effect. Investors have moved away from retail. Households are less inclined to shop in brick and mortar malls. Whether it's a mall in a suburb or something on Michigan Avenue, there's less and less appetite for retail properties. And retail as a percentage of the overall core core real estate universe has shrunk to below 16%. But that has been almost made up for by very attractive returns from the industrial sector. Sources of private real estate. Part of the reason that investors access real estate is diversification. The other real driver is overall income. The income is represented by that light blue bar or the light blue column. And in every instance dating back to 2007 and really dating back to the inception of the NCREIF Odyssey, which is a core private market real estate benchmark, that income has been consistent. Investors could count on that income even if valuations or property prices changed. We saw a deterioration in retail real estate prices, especially following the global financial crisis, but that income stayed the same. It's that income that allows or complements a portfolio ballast like fixed income. And ideally, that's something that we would expect to see. However, as employers potentially shift away from traditional office space, as we see maybe more widespread adaptation or adoption of work from home, the office space or office sector may be equally impacted. For now, we continue to see most major employers continue to pay their rents, but if this prolongs, we could see a deterioration in the office sector as well. With respect to REITs, and again, these are real estate investment trusts that are primarily a function of individual or retail investors who can access core real estate markets. Not surprising that we see regional malls, lodging, shopping centers as the sectors that experience the most significant deterioration. By contrast, data infrastructure, digital infrastructure, cell towers, those have all experienced a positive tailwind as the world is reacting to a backdrop of work from home and remote interface. And finally, with respect to real assets, and this is an asset class that continues to get more attention from institutional investors, these are asset classes that are income generating, that tend to be more insulated from changes in GDP. These are very large publicly used assets like regulated utilities, toll roads, freight, seaports, airports that offer some element of yield and a large amount of diversification. There still is some level of GDP sensitivity, but we see more and more interest in this asset class as a way to source return, diversify across or from real estate, and add an asset class that may not be represented in the portfolio. And then finally, private equity. Private equity, again, is an asset class that really is only available to larger institutional investors, but it represents probably a better source of growth. We see fewer and fewer publicly traded stocks in the US. 20 years ago or 25 years ago now, the number of publicly traded stocks in the US was probably somewhere in the neighborhood of 7,000. That number has now declined down to around 4,000. By contrast, we see an increase in private companies that are supported by institutional private capital. The universe continues to expand. It's a much more inefficient market. It's an area where active managers add value, and passive management just isn't available. So the key points here across almost every single time period, and especially those longer term time periods, whether it's 10, 15, 25 years, private equity markets have outpaced public equity markets. The foundation has a timeline or time horizon that really exists in perpetuity. And that this represents one of the best ways to grow capital over an extended period of time. It doesn't offer the same level of volatility that we get from public markets, but the trade-off, of course, is illiquidity, requiring investors to lock up capital for a period of 12 to 15 years. That doesn't mean that you don't get your capital back that quickly or over that period of time. It just means we're making an investment over a long-term time horizon. The foundation made its first private equity investment in 2014. The private equity portfolio is becoming more and more seasoned, meaning that we're starting to get capital back. And at some point, we'll be getting more capital back than we're putting in. And that allows just for the portfolio to grow. So far, it's been a positive experience investing in private equity. But again, the expectation, whether it's a buyout, growth equity, private equity is outpacing over the long term public market counterparts, whether it's the Russell 3000 or the MSCI ACWI. Now, we also expect differences by vintage year. We typically see more attractive private equity returns following years of depressed equity markets. And that's certainly true following the dot-com bubble, where we see vintages of 2000, 2001, 2002 offering significant return premium over a public market equivalent, in this case, the Russell 3000. So we would expect there to be valuation opportunities, buying opportunities as a result of dislocation in private equity markets. The other takeaway from this slide is that the dispersion of private equity is compressed as more and more participants have entered this marketplace. Market efficiency increases the price discovery process, and those valuation opportunities, those buying opportunities, aren't necessarily as impressive as they were almost 2 decades ago. But generally speaking, investing with top quartile private equity managers leads to more favorable outcomes than just holding a public market equivalent. So dispersions are compressing, but it's still an attractive marketplace, and certainly an attractive asset class for the foundation. And just to illustrate the valuation opportunities, as we see more and more capital pouring into public markets, those valuations become much more expensive. The transaction volume, the transaction pacing in the private market space is not nearly as fast, and there's still significant valuation opportunities based on this metric, and depending on the capitalization or the enterprise value level. Small companies with an enterprise value of, say, less than 400 million are much more attractive than public market equivalents, which is why it's important, especially for the foundation, to continue to commit capital according to its pacing schedule to deploy capital in private markets to take advantage of these pricing opportunities. This is a key portion of our overall growth portfolio at the foundation for Marquette clients across our platform. So the suggestion here, the inference here, is that private markets, despite perhaps compression with overall dispersion, are still very attractive, especially compared to public equity equivalents. And I think we have just a few minutes for questions. I'm not sure how much over we can go. I know some of you are eating lunch, but I will do my best to address any questions that you have.
Yeah, feel free to jump off mute and ask Dave a question if you'd like to.
Dave, this is Mike Hume. Anything you want to elaborate on your thoughts about the level of public debt? And that earlier slide you had, it's such an enormous topic, and it's one of those things that, can we go perhaps decades without it having negative consequences if it doesn't get brought under control? Or are you thinking sometime in the next 5 to 10 years, if it continues at these levels, that's going to lead to some negative consequences? I know you have no crystal ball, but I'm just curious if you have additional thoughts around that.
Yeah, and it's, so we can draw the experience that we can draw from is the global financial crisis, and that level of debt, or that level of bond buying that was introduced, which increased basically the balance sheet from 5% of GDP to almost tripled it to 15% of GDP. And then we started to see, as that debt rolled off, or as that bond buying program was discontinued from sort of 2015 on, that's when we started to see an increase in interest rates. And we never really saw any sort of overheating. We never really saw any sort of inflationary pressures, which is usually the catalyst for the Federal Reserve to start to raise rates. So they started to raise rates. There were 9 rate hikes from December of 2015 on that basically took rates from 0 to, call it, 250 basis points. And the last year, 2018, before we started to see rate reductions, was painful for equity market investors, and it was painful for bond investors. Rarely do we see a confluence of negative returns in equity markets and flat returns from bondholders. And in fact, since the inception of the Bar Cap Aggregate Bond Index, we've only had 3 years of negative calendar year returns within core fixed income. So I think the implication here is that when these bonds mature, when there is less upward pressure on bond buying and interest rates start to increase, that will perhaps reverse the course of very attractive equity market valuations. I mean, part of the reason too, and one of the screens that I didn't include, we've talked about in the past, are valuations, whether it's price to earnings, price to cash flow, price to sales, make stocks look incredibly expensive. Across almost every time period, stocks are in every sub-asset class, stocks are expensive. Well, interest rates are so low, they can be expensive, and that creates a tailwind. So if we start to see rising interest rates, that could put downward pressure on equities. We also think about perhaps a Biden administration increase taxing or increase in taxes on large cap companies or any sort of public companies, increase spending, that could decrease overall margins. So if we see rising interest rates, if we see a decrease in or an increase in corporate taxes, and just, corporate taxes dating back to the 1950s were as high as 50%. And they've declined precipitously since the 80s. That's really helped drive corporate earnings. So if we see a confluence of those two things, rising interest rates as a result of this balance sheet starting to unwind, and increased taxing or taxation driving down earnings, I think it could be probably a dire situation for holders of U.S. public equity.
Thank you.
Thanks, Dave. I think we had one more question in the chat that Nick had asked. I don't know, Nick, if you want to jump offline, or if you want, Dave, you want to just read it?
I don't think I can't see that. Feel free to read that, Kay, if you have it.
Sure. What are some catalysts to watch for which could signal the mean reversion in returns between growth and value? Higher rates, tech regulation, what else?
Yeah, so I think so is any value investor will share, and they're usually vocal about this. When that reversion happens, it happens very, very quickly, and it's usually attributable to some sort of exogenous impact. I think probably one of the biggest drivers would be increased regulation in the tech sector, and that was gaining more and more momentum, whether from Republicans and from Democrats. As evidenced by some of these large tech CEOs being called to Capitol Hill to testify. We're seeing more and more regulation. We're now seeing potential questions around who is able to communicate via social media or digital media. All of these create regulatory environments, and regulatory agencies are slow to catch up, whether it's financial regulation, utility regulation. But at some point, the federal government will start to intervene, and that could be a decoupling of large tech. There's certainly questions around antitrust, and I think that would lead to a significant and quick dismantling of technology. But that being said, we are operating in an environment that's much different than the environment that we operated in the 60s and 70s, especially in the U.S. We are no longer reliant on brick and mortar manufacturing. We are consumer driven, we are service driven. And if there's some sort of dismantling in tech or some sort of deregulation in technology, that could have consequences for American households, American workers, and of course, investors that have overweights to technology.
Well, I think with that, we're going to need to end our workshop today. Again, we thank you, Dave, very much for sharing your information and knowledge and your partnership, most importantly here at the Community Foundation. Thank you to all the professional advisors and committee members and board members that were able to join us today. We appreciate your time, and make sure that you get your continuing ed needs back to Lori so we can get those certificates out to you.